Well, welcome everybody to the July 2016 session or edition of the Roundtable. We've entitled it Let's Get Unconventional because some of us might need a break from watching both of the major party conventions. We did see history today with the formal official nomination of a female for the Democratic Party this year. So it's a historic day that many of us will think back and remember. It is a little bit of a party for us too. That's some of the reason for the balloons. I borrowed some of those convention balloons from Cleveland. This is actually our 6th birthday or 6th anniversary. We started doing this 6 years ago. We've done it every month with mostly the 4 characters on the screen there. My friend Ken Kabula, Cy Lynch, Hugh McManus, who happens to be unable to join us tonight because he's in Barcelona where it is currently 3:30 in the morning, and myself, Mark Robertson. Ken and Cy have both been dedicated long-term investors who share their knowledge in the form of classes and teaching events, both with their local chapters and nationally, and we really appreciate their participation in this event. And I've knocked around with quite a few long-term investors in our community too, and all we attempt to do with this session is to come together and share ideas and explore some of the philosophies and techniques of the modern investment club movement, using the principles promoted by both Better Investing and Manifest Investing. A little bit of housekeeping: if you have any if you would like to see slides or if you have any questions or seek answers, Mark R at manifestinvesting.com. And then you can also, if you or a friend of yours would like to be added to the monthly reminder list, I think Natalie sends it out a couple of times a month. She's not going to bug you too much, but her email is nkabula1 at comcast.net for a quick reminder. Here is our quick disclaimer to take care of the lawyers. No investment recommendation is intended whatsoever. We do a lot with real-time stock information for demonstration purposes only to illustrate, a process or a methodology that this community has used for now over 70 years. And we really are just using them as, again, an idea, as a suggestion for a stock to study, and that decision is up to you. We may be talking about stocks that we actually own in our real money personal portfolios also. But again, do your own homework, please. And we do think the power of demonstration is one of the reasons we've been doing this for 6 years, and you guys keep coming back. So again, here's our standing agenda that we pretty much use every month. We'll start off with an introduction and welcome. Again, welcome to those of you that have joined us in the past over these last 6 years. If you're new to this, we do try to keep it fairly informal. We also try to limit it to about 60 to 70 minutes. We generally push the upper end of that limit, but we do stick around for an open Q&A session afterwards down there at point 10. We do keep track of what we do, so we will be sharing results. We will be talking a little bit more about the selling concept. We would like to trim some of the fringes off of the portfolio and keep the total number of holdings down to a little bit more manageable thing. And then we'll go through our 3 stock selections. Like we said, Hugh sends his best greetings from Barcelona. He really was going to try to set his alarm and get up, but he found out he had a client commitment early in the morning over there, so he was unable to make it. And then we often do an audience poll. In fact, we usually do an audience poll with the stock ideas that are presented so that the audience can weigh in and vote. And again, there's the question and answer period. So I'll just kick us off with just a quick reminder of what we are doing here. We've had, over the years, we've had a number of guest damsels, guest knights, and again, the regular knights of the round table. We really do come before you to try to share an idea, hopefully an actionable idea that can be subjected to a study and consideration for purchase and, ultimately stewardship as an owner. We do try to limit the number of unusual selections in the portfolio. A lot of the portfolio is going to be what we would consider to be a core holding. We do want those selections to outperform the market. We'd like to see the overall portfolio beat the market by 5 percentage points, and we would like to see a majority of the selections we make beat the Wilshire 5000 when we compare the performance of an investment made in them at the same time versus the decision or the selection that we make. Here is a look at the long-term performance. You can see we are now up at 6 years. Relative return, again, is just simply the actual rate of return on the portfolio in comparison to what you would have gotten if you invested just simply in a Wilshire 5000 or a total stock market index fund. So at this point in time, after 6 years, we've actually beaten the market by 2 percentage points. The actual absolute return is 12.5% per year. That's annualized. And you can see that the outperformance accuracy, again, that's how often do the picks actually outperform the market, is approximately 50%. We'd like to see that a little bit higher. But again, both of these are pretty good. That dotted line across there, the red dotted line at 5%, that is our objective. We would like to get to that and hold it or beat it. But frankly, anything above zero means that you're beating the market. You're in rare company. Most professionally managed portfolios, including mutual funds, fail to keep up with the market over the long term. So again, like many investment clubs that are out there, Ken's in 19 clubs and most of them have blue dots above zero. We just like to see positive numbers there. That means that we're basically being fairly effective in what we do. Any questions or comments, Ken?
No, I'm real happy with what's been going on, Mark. 2% relative return the number 2 doesn't seem that big, but when you start to compound 2% over 6 different years and work that out into the future, that's a statistically significant number. Even 1% outperformance of the market is significant. So I'm very pleased with what's been going on. How about you, Cy?
I agree completely. We're in it for the long term, and 2% would magnify tremendously. And as you can see, we've bounced up around close to 4, and so we're headed in the right direction.
Okay, well, just go ahead and take a look at the portfolio itself. This is one of our manifest investing dashboards where we try to collect the critical information that's really relevant to any portfolio. You're looking at just the top 20 holdings. There's approximately 100 companies, because over 6 years, picking 4 or 5 stocks a month, and some of them is repeat selections and some selling. We do have about 100 positions in the portfolio. These are the 20 largest positions in the portfolio by percent of assets. You can see that Cognizant Technology is at the top. And again, just looking down the list just for now, just notice that there may be some names that are relatively new or fairly obscure. And that's a theme I'm going to be sounding off on tonight. I think we need as many, Mesa Labs or NICs down there at the lower 2/3. Core holdings are great, but at the same time, I think the potential for really cool performance over the long term is available from some of these smaller or lesser discovered stocks. And, we've proven that time and time again with companies like BioReference Labs and a few others that were off the main radar screen, but can be very rewarding. The way that you look at this, let me go ahead and throw in the repeat selections just so you can see it. To decode this, what we basically do is whether a guest damsel, or the audience makes a selection, we take and invest $1,000 into that selection. So in the case of Cognizant Technology, I think Size picked it 10 or 11 times. The total number of selections is 12. So $12,000 has been invested in Cognizant. It's now worth about $18,000. So Size 10 or 11 selections have actually done pretty well. So just going down the list, you can see many of those are multiple selections. I'm going to actually present Priceline tonight, so that'll be the 6th time that has been selected for the portfolio. But those are the most influential holdings in the portfolio.
Have you done Priceline before, Mark?
Have I done Priceline? I don't think so. I think I'm jumping on a bandwagon inhabited by both of you.
Yeah, that's what I was thinking. So if Hugh ever jumps on, it'll be a unanimous.
I'd like to see a few more like Universal Display. That's about halfway down the list. OLED is the ticker. We've only chosen that one 3 times, and it's worth $7,700 now. So we could use a couple of those to help us out. It also has a really nice growth rate, which is something that we're a little bit light on in this portfolio, I think.
Yeah, and that's sort of what I'm chiming in on. I'd like to see a few more of those if we can find them. Looking down at the bottom, we'll be looking at the portfolio driving characteristics, but 8.8% growth is actually a little bit anemic for what we're trying to accomplish. So we want to be discovering the companies that, well, like I said, Mesa Labs has 18% growth rate. That's because it's such a small company. I mean, I've raked Neogen over the coals trying to bring that here tonight. One of our mid-Michigan local favorite companies that's, again, small, fast-growing, and promising. So there's a number of companies on there, and there's also a number of companies that are in so many portfolios from Apple. By the way, Apple was up 7% after the closing bell tonight, which is probably good for many of us in the room, seeing how it's our most widely followed company at Manifest. Any other companies on there grab your attention, Ken or Cy?
Yeah, I like, I own NIC, Mark, and I really like that company. I don't know if it's a particularly great purchase today, but it's a little bit lower than halfway down. Its ticker is EGOV, but that's another fairly fast growing stock, and I think we've only chosen that one 4 times, and it's worth what, $6,400. So it's doing as well as Cognizant. What I'm going to show in a little bit. In fact, can I go to my spreadsheet right now for just a moment, Mark? What do you think?
Absolutely. In fact, yeah, we're basically going to enter into this. Let me just use this as an introduction, Ken. You know,
okay.
We have been talking about, you know, portfolio management really does come down to, you know, build it right, you know, design it, build it, watch it, be a good steward, maintain it. But the real challenge of portfolio management, true management, is in when to sell. And we have been going over a number of things. You can see them right there on the screen. We think that you could have quality degradation. We're going to show some slides where that possibly fits the bill. Based on return forecast, if a company's price shoots up, well, it gets way ahead of itself, the return forecast can drop way down. Ken was just talking about EGOV. That's an example of a company that we bought at 15 to 20% return forecast. The price has behaved quite well, and it's now down to 5 or 6% on the return forecast. So that can trigger it, depending if the portfolio needs it. Then we've been kicking around this notion of a relative return. We're going to dig into that a little bit for the portfolio also. And what Ken has been looking at tonight is, you know, what about those components of the portfolio that have just, you know, really not done what we expected? So why don't we go ahead and switch to that, Ken? You can kind of walk us through a little bit different take on this notion of a different driver for thinking about selling stocks.
I'm not sure that I would go here in a portfolio that I had been maintaining on a regular basis. But when I'm faced with this tracking portfolio, which is very different from a real life portfolio, when I'm faced with this tracking portfolio that frankly we haven't spent as much time worrying about getting rid of things from the tracking portfolio as maybe we should have, I've been just playing around with the spreadsheet itself. What I did was I highlighted everything on that dashboard that Mark just showed you. If you go to the Manifest Investing website, on the front page, you'll see some dashboards that are public that you can find, and one of them is called Roundtable. I opened that up and I highlighted the whole thing, and then I pressed copy, and then I opened up Excel and I pressed paste up in the upper left-hand corner, and so I made a spreadsheet. And then I took the dashboard, which was now on a spreadsheet, and I added 2 columns. I added a times chosen column, this column E right here, and I added $1 per choice. So if you chose something twice, if we chose, this is, what is this?
That's 3D Systems.
3D Systems, right. So if you chose it twice, then the total value is 552. That's on the dashboard, but it's 276 per choice. And then what I did was I sorted the spreadsheet by dollars per choice. So I haven't done anything really fancy at all with this spreadsheet. Notice that the growth column is on here as well as these 2 new columns. And then I looked at the first few. Well, I'm a teacher by trade, so I did a place. I said, where would I draw a line between a D and an E? And I saw a really big gap between 669 and 754. So I drew a line. That's my D minus E line. So above the line, I would have given an E to these stocks. And then on the other side, these aren't much better, but they're a little bit better. And like I said, there was a nice big gap in there. This only represents, if you really quickly sum this up right here, you'll see that this top part only represents 3.6% of the portfolio. And you'll also notice that, let's move that over again if I can, just a nudge. You'll also notice that there's not a whole lot of growth in most of these stocks right here. There's a few notable exceptions, Air Lease, Caesarstone, but this is fairly anemic growth for a portfolio that we're trying to aim at the stars. So I said to myself, well, can I go down here and why don't I start by picking on those that I'm pretty sure I put into the portfolio? So I picked out 3D Systems and Fossil and Strayer and Quality Systems. Yeah, I picked a lot of these. Vera Bradley, Raven, and I said to myself, just because we're doing house cleaning, those seem like targets for where we're going. Now, just to see if I was on the right page, I went to the bottom of this spreadsheet down here, and this is a lot longer list down here. And I drew my line this time between doubling your money. We put in 1,000, so doubling would be 2,000 per choice. So I drew the line between doubling your money and not doubling your money. And I noticed that, first of all, this was a lot bigger list. Well, what that says to me is that we're not nearly as good as being stubborn about good choices as we are about being stubborn about bad choices. Look at all the singletons on this list right here that we chose once, and they were either chosen once before we started involving the audience, so that would have been during the first 2.5 years before we started having an audience vote each time, or they were stocks that never made it through that audience vote when it was presented. You know, you went with somebody else's stock rather than the one that turned out to be pretty decent.
And I have a fun fact for the audience.
There's a heck of a lot of singletons on here. What's your fun fact, Mark?
Stryker was chosen at that first meeting 6 years ago. I chose it. So Stryker is that at 106 there. So that's $1,000 has become 2,700. That's a relative return of about 5%.
Well, and here's a fun fact to go with it. SEIC was my second choice all time on the round table. So here it is, $1,000 way back 60 months or 72 months minus a month, and it's become $2,900. There's a couple of other ones on here that were chosen, and the audience went along with them. This ResMed was 2 separate choices, no audience involved here, but OLED, great company, 3 choices. Look at that per choice, $26.38, worth $7,900 today. Anyway, I think there was, these are ones that you know, and I looked at this list, and then I went over to this list, and if I did average growth, it was certainly higher than the worst ones we were looking at. Now, there's a couple slower growers on this list, but this is a fairly decent diversity as far as growth between small, medium, and large companies on this list of best behaved stocks. So all I'm doing in order to start to bring this list down to a smaller size is this evening I'm going to suggest selling some stocks from this top 12 selections here, and I'm going to bring up one other one, and that's Staples. If you look down here at Staples, we've been really stubborn about Staples. We've chosen it 8 times. Each choice is worth about $800, total of $6,400 in there. It does represent about 2% of the portfolio, but you know, every time we chose Staples, we said to ourselves, this stock is going to pop once the merger between Staples and Office Depot Office Max goes through. Well, that merger has been squelched by the Justice Department. It's not going to go through, and I think it might be time to recognize that this 1.9% grower that represents 8 of our picks, you know, that's 2 months worth of picks over the 6 years, I think it's about time that maybe we asked it to quietly leave the portfolio as well. I know that there's a little bit of a, oh, I did it again, those are live links. There's a little bit of hesitation to freeze in a losing position, but Sometimes I think you just bite the bullet and freeze in some losers. And then let's look some of our big winners that are no longer projected to grow very quickly, and we can offset some of the losers with some of those winners, maybe take it up to 50 or 60% on the offset, and be happy with what's going on then. So that's my, I'm putting it on the floor, and Mark, you can show them some of the screens now that you have prepared
Yeah, I
to
took
talk about
Ken's
that.
yeah I took Ken's 6 suggestions and put them to a basically a point of view comparison board. That'll come up when we as we progress here, and I agree completely with a slight caveat on Staples. I think Hugh has pointed out that yeah the Justice Department has basically said there will be no merger, but I think Hugh still is holding out for a private equity takeout, of a turnaround situation. So it's not completely dead from a value opportunity standpoint. But
Of course, just one comment on that. Uh, Sometimes private equity comes in basically around the market and is just simply trying to, management believes that there is a future and they're willing to invest some money or find investors who will invest. The one that I'm specifically thinking of is Dell.
oh
If you
yeah,
remember,
absolutely.
Dell got taken private largely because it had been beaten up by the market, and Michael Dell and others felt there was a future for the company, but it didn't go private with any major premium.
Well, and if you've been around for a long time, Mark, you also remember that sometimes private equity or not so private equity scoops up a public company that we really like and doesn't really pay very much for it. A lot of us were investing during the times of Clayton Homes takeover
Yes.
by Berkshire
Yep.
Hathaway. So it's not always going to give us a really nice return when somebody swoops in and says they're going to buy it up.
Oh yeah, I think Warren Buffett owes us all at least $2 a share for Clayton to this day. Well, we're going to go through a couple of quick spreadsheets which show some of the selling considerations here in a second. But Ken, why don't you kind of walk us through? And again, that growth thing kind of jumps off the page at me. But here is the current report card for the portfolio. So why don't you just take the crowd through? How do we think
Yeah,
about
well,
this?
well, Manifest does a ranking of every single par value just exactly the same way we do a par value on a stock selection guide. And what he does is goes one step further and averages all those pars together every single evening, comes up with what we call my par, Manifest Investing Potential Annualized Return. And that basically is just saying that the average stock in the database is going to return a little bit under 6%. Well, we really believe that if George Nicholson were alive today, he'd be saying beat the market by 5 points. We think that's really what his 15% goal was saying all those years ago, only they didn't have the tools to measure things on a daily basis. So saying 15% over a long period of time was really saying beat the historical market. He knew the historical market was at around 10% for a lot of years, so he said set your goal at 15, 5 points above. Well, 5 points above this 5.8 is 10.8, so that's the beginning of where we'd like to try, and then we define a sweet spot, and we say don't be greedy, try to beat the market by somewhere between 5 and 10 points. And if the stock is showing you a par that's 10 points or more beyond the market, that might be too good to be true. Give it some serious consideration before you include it in your thoughts and your ins and outs of the portfolio. Well, our par is only 9.6, so we need to up our par. There's no doubt about that. I'd like to see that par up around 10 and a half, 11, 12. It's a little bit low right now, and that's one of the reasons why we're doing better than the market, but we're not moving ourselves up even to widen that gap between what the market is doing and what we're looking to do. So I'd like to see that moved up a little bit more. If you notice, we've set our sights about 4 points, a little bit less than 4 points more than the market. So let's push that a little bit. Quality is great. 80th percentile or above, quality is great. Nicholson told us a long time ago, if you're going to reach that goal of beating the market by more than 5 points, you probably want portfolio growth somewhere in the 11.5, 12% range. The rest of the beating the market would come from PE expansion, and the final bit of beating the market would come from dividends. So we'd like to see some PE expansion for some of our stocks, and of course, if it pays a dividend, we grab at it. But essentially, our sales growth is low. We need to be pushing this up to at least 10%. I'd like to see it at 10.5 or even 11. PE, total PE, slightly above where they're measuring the market average right now, but not bad, especially if you're being fairly aggressive and looking for good growth stocks. That's not a bad yield in today's market at 1.3, and we don't focus that much on yield, but 1.3% is not a bad yield for a growth portfolio. Good financial strength, I like to see 80 or above, and EPS stability. That's telling us basically, is that earnings line fairly consistent, fairly straight? And I'd like to see it at 80 or above, but 73 is not that bad. I'm not going to obsess about bringing that number up. I think as we bring the growth number and the PAR number up, I think that earnings number will probably take care of itself. I'm looking at diversity on the right side there, small, medium, and large. That's almost perfect, that red, green, blue kind of a thing. Remember, Manifest defines growth the same way that Nicholson defined growth in the original Better Investing philosophy. A company growing at 7% or less, we say is large. 7 to 12%, we say is medium, and 12% or more, we say is small. We're a little bit heavy on, I think that's technology up there, that light blue sector. But technology is where there's a lot of growth. So while we're a little bit heavy, I'm not certain we should be adding another dozen tech companies, but I don't think we're that heavy that we have to obsess about getting that to be smaller than it is presently. All in all, if we could focus on PAR and if we can focus on sales growth, I think that we'll be on the road to making this an even better portfolio.
Yeah, and I would just add, I think the blue slice is maybe a little bit too fat. And I also like to share that when we did the research on David Gardner's of the Motley Fool's tracking portfolio for the rule breakers, I often get the question, how much is too much technology? Well, he's got about 55% technology, which is, almost rabid, but he's certainly knocking the cover off the ball. And I think for a situation like this, that's not completely out of bounds. It's a little out of bounds.
Yeah,
so
go ahead. I mean, there's definitely opportunity in technology. That's part of why it's there. Why the numbers is as big. But again, let's just thinking really long term. I wouldn't get too quick to yank technology, because I think it was last month we were discussing how that sector classification may be becoming obsolete.
I agree 100%.
There may be a lot of companies called, quote, technology, and they're really not technology companies.
Yeah. So much of the number crunching that we do depends on where we place the company, which sector we place it in, even occasionally which industry within the sector we place the company. So I agree with you, Cy, that either you should call 99% of companies technology, or you should start to be a little bit more discerning on slapping that tech label on every single thing that comes across because it has a chip in it.
All right, I agree with you guys, but I'm going to move on before you guys force me to play with my spreadsheet and database. All right, let's talk a little bit about Ken's notion of, pointing out these companies that are relatively small positions that have just not performed as we had hoped or expected. And all I've done here is put together a quick look. And again, with some of the stuff you just heard, I mean, any company that's got a really low single-digit growth rate probably ought to be under attack on a list like this. I ranked them from lowest manifest ranking to highest. So that's the combination of the return forecast and the quality rating. So, I mean, the weakest company is at the top in terms of that combination. Again, this is one that just hasn't worked out. I mean, I love the idea. Um, when Ken brought it, and it made all the sense in the world, but it just simply has not panned out, at least not yet. But as Ken pointed out to me before we got started, or when we were talking in the green room tonight, selling one of these companies, we don't have to be afraid to do that. We can come back and buy it again if we really thought the story was strong, 2 months from now. So I think we have to be a little more cold-blooded with that sort of thing. The rest of the display just basically shows you a couple of key aspects: the value line forecast, Morningstar, S&P, the analyst consensus, just to give us a kind of a look around to see what other people think, including Standard & Poor's and Goldman Sachs on the far right, of these companies. And I think what we can probably do is just kind of go down and see if there are any of those that any one of the three of us would veto, and why. Because again, we kind of demand unanimous consensus, especially since Hugh is not here to defend himself on Staples. I think he's the only one that has selected Staples those 8 times. So we can kind of take it from there. I mean, my first shot across the bow would be Fossil, Ken. I agree. Their business model is damaged. I don't know how much is baked into the price. Everything that you see here is after expectations were actually reduced. The latest go around, you still have a decent forecast according to Value Line. The next year might not be so good according to the consensus and S&P, but I basically show it as a company according to that relative strength index that it's basically way oversold at this point. So I think I would urge hesitation on Fossil. And by the same token, I would urge hesitation on Staples. I think, again, it has probably bottomed out a little bit. Maybe we should think about a program stop out. If the price were to reach, we can pick a number, 10, 11, or whatever, after we take a look at it. But we could probably put some type of a program stopped out. I think the story on Staples is we missed it. I mean, I don't remember the number, but I believe Staples got up as high as $18 a share within the last year or so. And that's kind of the way I feel about that one. But the other ones...
Well, Mark, I'm going to counter the Staples argument by just saying, it's 2% of the portfolio.
Mm-hmm.
And that means that we're pegging 2% of the portfolio to grow at only 1%. And I just don't think there's room in this portfolio for that kind of grower. We're saying we want more growth, and yet we're willing to keep a 2% of the portfolio pegged to 1% growth. As far as Fossil's concerned, Fossil was one of the things I brought once or twice to the round table, and I would say that if it percolates back up towards the top and gets itself back in order, I would be one of the first to take a good look at it. Frankly, for example, I took a good look at Coach in the last couple of weeks and have decided that if Coach keeps moving along the way it's going to be moving, I might be bringing Coach back to the round table again. But I see nothing wrong with freezing this position, and then if we like it 6 months from now, a year from now, 2 years from now, then adding it back in. As far as 3D Systems is concerned, I went back and looked at the presentation that I originally gave on 3D Systems, trying to learn something from it, and I devoted about 35 seconds to the disruption caused by the personal computer when it first entered our lives back in the 80s. If you're old enough to remember the computer coming in as kind of a toy almost, and with people all over the globe saying, what would you ever use a computer for? And I remember the cautionary tale I gave at that point. Does anybody know the first computer company? Can you name it? And the first one that made real money for people wasn't Apple, it was Commodore Systems. And that one fell by the wayside pretty quickly. Well, 3D Systems has been joined by a lot of competition, and it just didn't prove to have the chops to compete, or thus far it hasn't had the chops to compete. So I'm going to vote yes on all 6 of them to get rid of them, but I understand where you're coming from on a couple of them.
All right, I'm holding my Staples veto in abeyance to hear what the stubborn Cy Lynch says.
I'm not a fan of Staples, and so I say that. The other, and this is more of a philosophical question, and what exactly is the purpose of our portfolio and what is our goal? Is it to, if it's to be a predominantly growth stock portfolio, then probably 2% doesn't belong in a company like Staples. I'm personally thinking of my growth stock outlook better investing portfolio. There have been times that I have thought that there was a potential special situation in a company, but that it just really no way fit a growth portfolio concept, and I pulled the plug painfully on a pick. Sometimes for good reason, sometimes it came back to bite me, as far as return. So philosophically, if we want to have a lot of, or significant value plays and turnaround situations, Staples may be one. But that said, even if Staples, as Hugh points out, is one of the largest online retailers, they have a significant online retail presence. They apparently are probably going to end up being the survivor of brick and mortar office supply. All of that said, is that an industry? I mean, is Staples going to be anything other than a economy quick grower going forward? I mean, I just don't see a driver to push that growth significantly higher in Staples. So I would probably lean toward pulling the plug. However, in fairness to Hugh, Hugh's not here to argue for his company. So, I can also see saying that we will hot seat it big time for next month.
I can live with that, Mark.
Yeah, the compelling part of it is showing at that 1% growth, and I think anybody who looks at the company in the industry thinks that that's a realistic type area, for that number to be in. I mean, it's not, certainly not a double-digit growth company anytime soon. So I guess we're at the point of the only one that really is vetoed at this point would be Fossil. I would also, I don't know so much about Vera Bradley. I think Vera Bradley may have some decent times ahead of it, but again, because
is your wife standing over your shoulder with her Vera Bradley bag ready to smack you?
She might be. I think the daughter might be more dangerous. And, one of the things I look at here is, again, the 1-year analyst consensus estimates on price targets are notoriously unreliable, but it is I do believe it probably drives the market a little bit. Vera Bradley has one of the better outlook from the analysts who tend to push people around at that 40% number that's hanging out there in the yellow. So I think, those two, plus it is a, 5% grower. So those two at the bottom are not killing the overall growth rate of the portfolio. Fossil definitely has some bumpiness ahead of it, but no, it's definitely worth dragging along. So I guess I would withdraw, and we can always, if Hugh thinks that Staples is worth going back into, he can begin building positions again, because it is. I mean, it's down. It's at 50% of where it was. I just looked it up. It was at 1940 a year ago. So that was one of our opportunities to get out of some of those positions. So
Right.
So what should we do? Should we keep any of them or not?
Well, like I said before we started, Mark, I don't see us agonizing over the bottom of this list. They've lost us huge amounts of cash, all 6 of them. There's probably another dozen that have lost us huge amounts of cash. I would rather agonize over the top of the list that are slow growers.
Mm-hmm.
And that's where I would like to spend the time. I think these represent such a tiny piece of the portfolio. Let's just get rid of them. If we like them in a year or 2 years, let's add them back.
Well,
yep.
Go ahead, Si.
And one thing I'll make an observation from a somewhat of a gamesmanship point of view, as well as if this were a real dollar portfolio point of view. Let's assume we sell all of them, and Hugh or any of us want to buy back into any of those. You can do it next month, and you're doing it at the bottom which for the tracking portfolio purposes, you're looking at a potential upswing. Okay, that's the gamesmanship perspective.
That's compelling, Si. That's really compelling.
Well,
If it were a real dollar portfolio, there's something called tax benefits
yeah.
that you would also be doing. So,
Yep.
so there's a learning process on both parts.
Mm-hmm. Well, I'll tell you where my angst lies. I'll try to keep this brief because we do want to get started into our stocks here in a couple of minutes. I've been looking at portfolios that have hundreds of stocks in them that have achieved very high performance levels. So I'm not that disturbed by the number of holdings, but probably the biggest disturbance to my soul here is, the conditions on the fossil analysis are fairly current, and they're basically in the buy zone. So we're talking about selling a stock that's basically in the buy zone, and we basically teach that as you look at your portfolio, you don't really worry about, where's it been so much as, where is it positioned to go from here. And in the case of either Vera Bradley or Fossil, I think they are fairly well positioned. They have their challenges, obviously. So I just want to, my thoughts are that Vera and Fossil will actually rank in the top quintile of opportunities out there. So it just kind of doesn't feel right to me. Plus, it's not that helpful on the growth side of the portfolio. So I guess I would say jettison the top four and come back and we'll fight over the fifth and sixth ones later.
Agreed.
Okay, we'll go ahead and go with that.
Well, but I didn't hear Si say anything.
I think he's already in agreement. He's ready to get rid of them all.
Okay, all right. Then let's just drop four. That's four.
Confirm that size.
Four. Yeah.
Now here's where some of the other pain comes in. We really don't have time to dig into this too much. We're going to have to do this more in the future, but here are the stocks that have underperformed that have been held less than 1 year. These are the ones that we watch the relative return for. And, again, on this one, there's a lot of angst here, and we're going to go through this again next month, but companies like Skyworks Solutions have actually underperformed the market by over 30% over the last almost 10 months. And there's some awfully good companies on this list that, don't rub me the right way. There's only a couple of positions, 2 or 3, that actually have gone above that arbitrary 20% down relative return number. And again, for the audience that is not familiar with the concept, we're talking about watching a company's performance versus the market from the time of purchase, and then using the reality that a company has underperformed the stock market, the Wilshire 5000, by 20% since the time of selection as a potential indicator that maybe we missed something, or maybe something is horribly wrong within a sector or an industry or a sub-industry. And I think, ConocoPhillips is an example of that. The oil and gas, mega companies have just not turned around yet. And those companies have still lagged the market quite a bit over the last year. So again, we haven't actually picked a number. The Skyworks number bothers me a little bit. Any thoughts on that, Ken? What would your perspective on Skyworks be today?
I'm still in clubs that are adding to their position in Skyworks, Mark.
Mm-hmm.
I listen to the arguments. I still think that Skyworks tends to bob around with Apple news, and I still think that people think that more of Skyworks business goes to Apple than actually goes to Apple. Now, I don't know how you get the idea, how you get the information out there, but Skyworks does a lot of business with other customers, and yet it seems to move very closely to wherever Apple's going to move, or in fact, it seems to move in a magnified way whenever Apple's moving down. So, I do notice that Si's name isn't on any of these right here. Si, what are you drinking that allows you to stay off this list?
What do you have?
Don't forget, my name's not on there either.
Yeah. I do, all valid points. One of the things I think we're going to have to dig into in a little bit more details, I think there's 2 factors that come to play here. One is the quality of the company. Skyworks is a fairly high quality company. And then this thing that we talked about a little bit last month, the price stability. And And that probably helps us to adjust that, what I called earlier, an arbitrary 20% figure into something more manageable. I think we have to be more, I think we have to follow the lessons of George Nicholson. I'll just talk in terms of Mr. Nicholson, where he talked about anytime you're talking about developing a guideline, for making decisions, there has to be something inherent to the stock you're studying. And I think that's what we're running up against here. So
Yep.
I would campaign for whatever we come up with to condition that arbitrary number, that arbitrary limit. It probably has to include a function that acknowledges the quality of the company and the price instability or the price stability.
Mark, I have two mentors from when I was learning to deal with my first profession as a teacher, and they taught me to look at numbers and to look for natural places where numbers separate. One of my mentors, Dr. Ted Bennett, would say all the time, numbers will speak to you if you just put them on a list and look at them. And I think that there's a real dividing point on this list that might be telling us something. It might be too small a sample for us to really get the divider, but I'm looking at that division between 20.1% and then 23.9%. There is no other gap like that going on anywhere in this list until you get up to those two Skyworks that are just way off in the top of the breeze up there. And I'm wondering if the bottom half of this list is basically telling us that's too small a number for relative return within a year. That's within error, that's within normalcy. And maybe when you get over that 20% or get over that 22% or 23% or start approaching that 25%, maybe that's the place where normalcy is telling you that this is outside the realms of normal, and you should be using the number to help you make some decisions then.
I think that's where we're going to end up.
I hope that was clear, but
yeah, this isn't meant to be I suggest we sell any of these other than, Skyworks is, above what we had discussed as, potential triggering limits. But again, I think we're going to have to figure out, I can point to other stocks that like my Iconics brand selection, which wasn't as high quality, and it definitely made more sense to put that 20% limit on companies like that. Retailers can be an example of that. So let's go ahead and table it for now, and we'll just come back to it and keep scratching our heads about it. Maybe we'll have something we can dig in deeper on. So with that, let's go ahead and get to our stock presentations. We've got about half hour left or less. So
I'm going to try to keep myself short and keep this moving real quickly here. I'd like to get my name off that list as many times as it's on it right now. So I've diverted for the last 2 or 3 or 4 months to up, straight, and parallel. I've gone back to the basics. Tractor Supply is what I'm bringing you tonight. When I sat and thought about a company that I wanted to bring, I had on CNBC in the background, and we had a housing report today that showed that housing sales of existing homes was at a high water mark for the last decade. We have great numbers coming out of a lot of retailers. In fact, retailers seem to have spun on a dime in the last 3 or 4 months and seem to be really moving in a positive direction, and especially retailers that have to do with the household maintenance or household improvement area, and that's certainly Tractor Supply. So the first place I went, Mark, was to Manifest. I looked at the chart right here at the bottom of everything. I wanted to see, first of all, I wanted to see 2 or 3 years of consistently high quality. I see that since about 2014, the quality has been in the mid-80s and actually been rising during that time slightly. I looked at that last bar. I hovered over that last bar, and Mark, if you would click just once. I have an animation in this slide.
Oh, they must not have come through on the, sorry.
Okay, well, I hovered and the animation showed me that at the very end, there it is, and at the very end of that red line right there, that was for May 2016. The par was 9.2. Remember, I like to see high quality, and I like to see a par that's at a fairly decent point compared to all the other pars on the chart. For example, buying Tractor Supply back where it hit that real high peak over there, that would have been a great time to buy Tractor Supply with that really high par right there because it hit that high par at a low price. So new slide, Mark. I looked at the top, and Tractor Supply is a real high quality, a good decent par value, 11.7%. I'll take that any day in any good size medium stock. Again, I looked at the quality metrics that are on that same page, and Tractor Supply has a great balance sheet as witnessed by the 23.7 points it gets out of financial strength. Our earning stability above average at 15.6 points. Remember, 12.5 would be average. It has average sales growth. It matches the market and slightly above average profit margins. So all in all, a really high quality company. And I was very pleased with everything I saw here. Click again. I went to the Eagle for Tractor Supply, and I noted that Mark's numbers coming from a conglomeration of analysts, from an amalgamation of analyst numbers, if you will, has sales growing at just under 11%, has margins exceeding 6%, share value of about 125 million shares, and a PE ratio forecast of around 25. So I kind of digested those numbers. Click again. I went to Value Line. It's trading at a price very close to what this Value Line is showing. I think Tractor Supply is at $91 and change. So the 92 means I have some pretty good projections going on here. Growth at the low side 6%, total return at the high side 14%. Those are numbers that I can accept in a company that I'm taking a look at. I like to read the capital structure box if it'll tell me anything about the debt that the company has. And I noticed interest coverage on this capital structure box of over 25 times. That's a nice thing to know. Annual rates box, sales at 11. That was awful close to Mark's 10.7. Earnings number at 14%. Value Line is expecting earnings to grow more quickly than sales, at least for the next 3 to 5 years. Click again. I went to the table on Value Line. Their average PE ratio was at 22, and I noticed that they were seeing a lessening of the PE from where it is today. The most recent fiscal year, notice the average PE was about 29, so we see a consolidation of PE. It's moving in the downward direction. Keep that in mind. Great store growth going on. Look at it in the numbers. Remember, dark numbers are estimates going forward. This last one is 3 to 5 years from now. And profit margins also growing at a pretty healthy clip, adding 1% to the 6.6 profit margin 3 to 5 years from now. That's a pretty healthy growth for any retailer to make happen. Click again. So then I went to the website. Here's what Tractor Supply says it does. It basically sells things to the gentleman farmer or to people that fancy themselves as gentleman farmers. You might only have an acre, but if you're growing a big vegetable garden, Tractor Supply might be a place where you do a lot of shopping, a lot of business. It's also a great place for animal owners, whether they're pets or just a couple of farm animals or herds of farm animals. It's a great place to get supplies for your animals that you would have on your gentleman's farm. Click again. These are what they see as growth drivers going forward for their business. They're focusing on these 4 categories especially, and the biggest grower, the fastest grower right now is in services. They call their services do it for me or get it to me. And I think those are clever names to indicate that while a lot of folks like to see themselves as gentlemen farmers, they like to leave a lot of the work for other people to do. Click again. Strong same-store comparisons, that's what this is showing right now. When you can have same-store growth growing at 3%, and that's the lowest number in the last 5 years, I think you're doing fairly well. That's an average there about 3.5%, 3.75%, and they anticipate that kind of same-store sales growth to continue on for the next 3 to 5 years. Click again. They have a merchandise assortment that's pretty heavy on livestock and pets. That's the bluish part of the circle. Hardware, tools, truck parts, things like that. A lot of seasonal gifts and toys. I was very surprised when my oldest granddaughter directed me to Tractor Supply to get boots that she wanted for last Christmas. Clothing and footwear, agricultural products, which used to be a much larger part of their business, has shrunk now to about 5%. Click again. They're opening stores all over the country. You can see that anything that's in blue, whether it's light, medium, or dark blue, is where they've opened new stores in the last fiscal year in 2015. They opened 114 new stores in 33 different states. Click again. They like to talk about the 2,500 opportunity, and what that means is they think that there's room for 2,500 Tractor Supply stores in the continental USA, and you can kind of see the penetration in the different regions, Midwest, Southeast, and Far West. You can see the penetration and where there's room for more growth. Click again. Tractor Supply is setting targets for itself, and it would like to see target store growth. The percentage is going to begin to move downward as we move out to 2019, because their plan is to cap the number of new stores at about 120 per year starting in this particular fiscal year. Click again. These are targets that they've set for themselves, and the biggest takeaway that I took away from this slide was that they'd like to grow their earnings in the mid-teens, and in fact, in a different presentation, they actually named the number 14 or 15 for annual EPS growth going forward. Click again. They allocate capital. They pay a significant dividend. They like to invest for growth. That's putting it into their new stores. And they're quite aggressive as far as share repurchase occurs. Notice that 15% of their operating cash flow is going to share repurchases. Click again. In the last 5 years, you can see their capital allocation. And then in the next 5 years, you can see that they're increasing the dividend, and they're beginning to decrease a little bit the amount of share repurchase going on. Click again. Here we're looking at the online tool, and we're looking at the 3 lines for Tractor Supply. Fairly nice, decent lines, profit following earnings per share pretty closely. Price bars got a little bit ahead of the growth in earnings, I think, but they've kind of leveled out in the last 16 to 18 months, and this might preclude a buying opportunity right now. They don't carry much debt, and again, remember, Value Line said 25 interest coverage going forward. Click again, Mark. I did a preferred procedure based on 10.5% growth. That seemed to be right smack dab in the middle of all the different sources that I read. And going at that 10.5% growth, that gave me a 12% compounded growth for earnings. I did cut the shares back to 125 3 to 5 years from now, but that could even be smaller with the aggressive share buyback that's going on. The smaller the number there, the higher the percentage the result will be going forward on the earnings per share growth. So I accepted the two numbers, 10.5 and 12, and I created an SSG. Click again. And that SSG gave me returns somewhere between around 10 to 15%. That's in the exact same ballpark that Value Line was sitting. maybe a little bit more aggressive than Value Line, but it's in the exact same place that Manifest Investing was sitting. I was very happy with my SSG. I would take this kind of growth from a medium-sized company any day you want to give it to me. So I'm going to place, click again, Mark. I'm going to place Tractor Supply Company in the portfolio. We don't have a lot of retailers, so we'll put a retailer in. We just took a retailer out, so let's replace it with another one.
All right, I'm going to be away for a few minutes tying up my tomatoes.
All right.
You may refer to me as Gentleman Farmer.
A gentleman farmer, okay.
Yep. Let's go ahead and press on with United Therapeutics. Take it away, Cy.
All right, thanks a lot. Sorry, I missed the selling party. My Comcast cable went out. But anyway, I am back. You can see United Therapeutics, while as we talk a little bit about it, I would call it a somewhat speculative, certainly a volatile company. On the other hand, you can see from this slide, certainly on the sales growth, a very steady company with significant history, and even that earnings line is a relatively consistent line. So for a smaller, somewhat volatile company, it has a pretty good track record of consistency. The only other thing that I'll mention before we move to the next slide is Value Line's low total return for United Therapeutics is 17%. So Value Line thinks there's certainly some potential there. Next slide. Here's where I came up with United Therapeutics today. For tonight's pick, I just went to the stock research tab on Manifest, and this is what popped up. You see Jazz Pharmaceuticals was the very top. I just couldn't wrap my arms around Jazz and understand it well enough. I knew a little bit more about United Therapeutics and checked it out and decided to go with it as the pick tonight based on this. Next slide. Here's just the quality actual numbers on United Therapeutics. You can see the calculated rating is 64, but that equates to about an 82 high quality ranking on Manifest in the percentile. And notice on the Chronicle, the quality is moving in the right direction. One thing that you will note on this slide, the price has popped just a little bit in the last month, which has pushed down the relative return expectation somewhat, but notice it's been trending down because I think there have been some lowered expectations for the company as well. But again, that seems to be leveling off. Let's move to the next slide. Here's a little bit of information about the company. If you go to the website, they seem a little bit new agey in their presentation. Here is the landing page for the company. You see they describe themselves as a biotech company focused on development and commercialization of innovative products, and they have trademarked the term medicines for life. They have 5 currently approved products that we'll see on the next slide, seeking to meet, as they say here, unmet medical needs on some niche markets. Next slide. Here are the 5 products that they have currently on the market with the sales during the first quarter of fiscal 16. So you can kind of get an idea for what they do. Their annual sales are around $1.4 billion dollars. So they are just barely into the medium size if you go by annual sales. But again, they've been around for a while. Their products, the first 4 products are all for lung conditions, pulmonary arterial, PAH, pulmonary arterial hypertension, which is a heart-lung condition. The last Unituxin, I believe it is, if my eyes are seeing correctly. That is for a rare but very, very fatal and important childhood cancer that also has some potential application to adults, but it's a childhood cancer condition, and you can see that is a new product in 2016. The other four are all for the pulmonary arterial hypertension market. So that is where their focus is, and the Remodulin at the top, that is their oldest product. That's been around since 2002. Next slide. Here is the Eagle for United Therapeutics. If you do an SSG, and in particular if you do it using Morningstar data, I mentioned during just kind of our early discussions today, I think it was before we actually started officially, Morningstar includes some non-recurring gains. United Therapeutics has a significant amount of their compensation to their officers comes through stock ownership plans, and because their stock price has fallen significantly over the last 12 months, they are actually showing a gain, a reduction in expenses on a GAAP basis because of stock ownership plans and the way that the cost model works. Their costs have gone down, and it greatly increases their GAAP earnings. So actually, if you look at GAAP earnings, you will earnings per share over the next 5 years will stay flat. If on the other hand you use value line numbers, my projections work out to about a 10% increase. But here are the judgments off the Eagle using manifest numbers for the actual data and historical numbers. My projection for sales, I think, is right in line with Solomon's default, which is 9.5%. Net margin, you notice, falling. Again, some of that is due to the GAAP issues, though most of it simply is with some of the products coming off patent protection and generic competition. It does appear that the margins will be declining over the future, but the sales growth and the current margin is high enough that it still is supportable. Notice shares declined slightly, but roughly staying relatively flat. And again, you can see using manifest numbers, earnings per share are actually projected to decline. However, as I say, that includes some non-recurring gains in the 725 current figures. If you exclude that, it works out to about a 10% earnings increase. The biggest growth opportunity for this particular company comes in PE ratio. Notice the current PE is 6.4. Again, that is artificially low because it is based again on these GAAP numbers that contain figures that everyone knows are non-recurring gains. Also, there was a joint venture product with a larger pharmaceutical company whose name right now is slipping my mind, but it did not get FDA approval, and when that did not come through, the stock price took a bit of a hit. But again, that was the price probably getting somewhat ahead of itself, betting on this upcoming product launch, whereas the 9.5% sales growth that I have is based on current products. So certainly anything new will be a pleasant surprise, and you see those projections working out to a projected annual return of 14.5%, which is pretty healthy in this current market. So I am adding United Therapeutics.
Good, thanks, Si. All right, I'm going to go back to Priceline. I kind of like the up, straight, and parallel here, and like Ken said, we're trying to keep our names off that dog pile at the beginning. This will be, I believe, the 6th time that Priceline will have been selected. I think most of us here are quite familiar with Priceline. It's basically a travel company, online travel company that does airline tickets and hotel rooms and car rentals, vacations, all that kind of stuff. And it has kind of a William Shatner name your own price type mode of operation, and not really a small company. I believe they have 15,000 employees, but you can see that they have got quite the track record over the last several years, and that the stock price there by the green bars has kind of plateaued a little bit in recent years, but it seems to be recovering nicely. In fact, the last month has been quite good to the company, so it's got a little bit of momentum. I do like to show you just a few things that I kicked around before ending up at Priceline. This is our Sweet 16 for this month. These are the companies that have the best combination of return forecast and quality rating. There's a whole lot of other repeats on there that I didn't really care to chase, trying to find something new for the portfolio, and I also wanted to make sure that I identified an opportunity that had, better than 12% growth. So I figured, why don't I go specifically looking for that type of thing. Did run into one company on here that kind of just nudged me a little bit. It's Chemico, down towards the bottom there on the Toronto Stock Exchange, CCO-TO. They're a uranium producer. Here's what they look like. I did not select this company, but got to wonder if that hasn't been stuck in the mud for 6-7 years. There's as many as 100 new nuclear plants that'll be going online in the next few years. Some are obviously coming off, but might be an interesting study to see what you think about the future of nuclear power and the need for uranium, because it can't go away overnight, as you've heard Hugh talk about on the oil side of things, the petroleum side. And if those projections on the right-hand side of this chart come true, basically sales at all-time highs in the next 3 to 5 years with earnings that match it, it's actually quite consistent for a company that's in this type of an industry. And you could be looking at upper double-digit returns for a company like this. So I basically switched gears and went looking for something that had high quality, high return forecast, and high growth without too big of a PE, and just basically settled in on Priceline towards the middle of that list. I could easily select Cognizant because that looks pretty good, but Cy would accuse me of jumping on his bandwagon. I really tried hard to see if Neogen could fit. The prices run up a little bit, and with a little bit more conservative estimates, maybe a little bit lower PE expectations, it's really not strongly in the buy zone at this point, so I backed away. I was really strong on Boston Beer about 2 weeks ago, but the price went up like 30%, so that kind of wrecked that one. A little early, but right on that one. So here's what it looks like. There's the picture from the front page. Again, a very steady profitability in terms of that net margin, really checking in fairly steadily in that 30% range, not too much of a plus or minus. Same thing on the PE ratio for a company like this that, again, is one of those technology companies. I'm not even sure where it's listed sector-wise, but it's definitely a very tight profitability, 30%, PE 20-ish over the time frame. So you can see the results of a quick rundown on a worksheet for the company. A mid-teens growth rate. I used 14% that you can see on the chart here. Used a slightly lower profit margin than what the analysts expect, so 32 versus 34, and a little bit lower PE. But again, came in that low teens area, call it 13%, which happens to match the value line low total return forecast. And the return forecast per the consensus estimates from the analysts is in that 18 range. So again, we're looking at a company that has delivered very steady results, much steadier than most people would have expected over the years. I think that the growth rate of 14 to 15% is the right kind of elixir for our overall tracking portfolio, and that's enough return for me. It's enough percentage points above the average stock that this is a solid company. They seem to be very well managed, so we'll be adding Priceline to the mix. So with that, Ken, let's go ahead and run the poll. The results from last month are on your screen. Do we still have Ken?
Yeah, I'm still here. I've lost my, there it is. So let me get this poll going here, Mark.
You were killing things?
No, I just lost my control panel from GoToWebinar, but it was hidden. So let's bring this poll question up now, and do you see it? Yeah, I think so.
I don't get to see it.
I see it.
Okay.
My prediction is this is going to be a horse race. Those are three better, more competitive selections than we've had in a while.
Okay, we're at 85% voting, so I'm going to give it about 3 more seconds. That's 87%, 88%. Just use your mouse and click on one of the choices right there.
We always forget to tell people if they're here for the first time, you're welcome to vote.
Yeah, everybody can vote. It doesn't cost you anything, and we don't know how you voted. So I'm going to close the polls now, and I'm going to share the results. And you see the results, Mark? You know, you don't. Okay, we have Tractor Supply at 44%, and United Therapeutics at 26%, and Priceline at 22%, and 8% of you like none of the above. So we'll add a audience position in Tractor Supply to the portfolio as well. Mark, we're getting a lot of comment from 3 or 4 people, people that I know, and I think there's a basic misunderstanding of the kind of portfolio that we're trying to put together in the roundtable here. I'm going to make a 2-minute attempt to come up with an analogy about what we're trying to do. Think about all the stocks that we put in Better Investing magazine. We put in 12 stocks to studies every year, I guess 11 because they print 11 months during the year. But we really would like, if possible, to know how good those picks are, and we would like, if possible, to know how good their picking ability is in the aggregate, in the whole. So one way to do that is to begin to track the picks that you make and compare them against what a similar investment in something that represents the market as a whole or some subset of the market would be. These portfolios that are called tracking portfolios are never meant to mimic the kind of portfolios that you would put together for a club or as an individual. If you were an individual trying to follow 100 stocks or more, I would say that you're in a fool's mission. An individual portfolio, maybe you have a dozen or 15 or 18 stocks in your portfolio. Maybe as a club you have 1 or 2 stocks for every member that happens to be in the club. But this is a tracking portfolio that's meant to only give us some basic information about how good are the stocks that we pick on a month after month basis doing, what's it doing in the aggregate, and are there positions where you should be informing the group that you no longer think that the choice that was made for stock X is a good choice, and you accomplish that by removing it from the portfolio. Maybe it doesn't do us any service to say that we're selling it. We're basically removing it and freezing its position in the portfolio. So that's what we're trying to do. Mark, could you add anything to what I just said to help clarify that point a little bit?
Yeah, I mean, that's a fair way to put it. Keep in mind that our overall objective is to pick stocks which outperform the market over time. So what we basically need to do, place a little more emphasis on, is watching for those ones who are not positioned to do that going forward. Again, it's a matter of picking out the stocks that have the low return forecast. So we do watch them all. We keep them on the dashboard and we watch them, and it really does come down to that. I think It really is a portfolio. I think Ken is maybe we are selling them. I mean, we basically are selling them. We keep track of a relative of a internal rate of return on all of the transactions in the portfolio for all of the decisions made. And one of the things I think I'll do for next month is just for a quick demonstration, show that rate of return on a portion of the portfolio, maybe the first 4 stocks we selected 6 years ago, showing you the 3 sold positions, and there's 1 still active position in Stryker, and what the rate of return on those 4 decisions, actually 7 decisions counting the selling decisions, are at this point. And maybe that'll help drive the point home. It really is the rate of return achieved on a set of decisions made over 6 years. And,
yeah, I guess the point that I was trying to make, Mark, is that those of you that are thinking that this is an example of a portfolio like you might put together, in real money, or that like a club might put together, that's absolutely in the wrong direction. That's not what this exercise over the past 6 years has been trying to do.
No, we're trying to share ideas every month and keep track of how well we do, and we want the collective result of those actionable ideas to be, we basically want to keep track. For a portfolio, that if you want to watch a portfolio as if it were a real money portfolio managed using our conventional methods, Tin Cup is an example of that. There's never more than 16 to 18 companies in Tin Cup, and it's, the performance, every decision made since 1994 is documented, so you can actually take a look, and that's just an example of a portfolio that's managed in a more conventional way. Again, combining probably the most powerful differentiators when you're looking at a portfolio like we would be taking care of personally, or Tin Cup itself, you shop inside the portfolio first. And our mission here, and I think I'm going to hammer this home over the next several months, is our first mission should be to try to discover a really exciting potential outside the portfolio. And we'll do our best to keep the numbers down, but taking a look at the performance of that Renaissance Technologies hedge fund, they've got like 800, maybe 1,100 stocks in that portfolio, and they have these exorbitant returns over the years. So it can be done. It can be done, and again, that's a little bit different than what we would talk about as conventional portfolio management.
Yeah, Cy, the series of articles that you've been writing for Better Investing magazine are basically managing a traditional portfolio, much like an individual or a club might put together. And you've been doing that for how long, Cy?
About 7.5 years, going almost 8 years now.
Okay, and those articles appear in BI magazine at least half the time, at least every other month, and sometimes they follow month by month even.
Yes. That is correct. And one other thing about a tracking portfolio, and again, perhaps we should be a little more attentive on the selling side when something is not a current opportunity, but a way that I've always looked at tracking portfolios, as well as the way Ken described it in particular, just tracking how well the picks have done to evaluate, but also it is somewhat of a laundry list of that was a best idea at a given point in time, and that in most cases is still at least a potentially good idea and something to watch, maybe be concerned about entry point for price, but an area where someone looking for personal stock portfolios can go for current stock study ideas. So, I think that's another advantage. You could call it, while of course it's a tracked dollar amount but not real dollar portfolio, but a tracked portfolio, but you could think of it potentially even as a watch list for manifest followers and subscribers. And in that group, I'm including roundtable followers, subscribers.
Absolutely. Any one of the portfolios can be a source of ideas. In fact, that Rentech portfolio has got several hundred stocks in it, and again, we will be mining it for undiscovered ideas.
I mean, yeah, great point, Cy. Great point. Mark, we have the question box cleared. We have a comment from Faith, and Faith says she liked watching the screen and listening to the sweeping the counter of the disappointments discussion at the beginning of our discussion about getting rid of some of the stocks. She found that very helpful, and she it's kind of cathartic. So thank you for the comment, Faith, and I don't have any other comments in the question box, and I don't have any hands raised. Now, usually when I say that, three hands go up and the questions come in. But if we don't have anything else, we're just about at the time when we call it a night. Things are staying calm, Mark, so I want to say thank you so much. This has been stimulating this evening. I like it when we get to a place where we don't often talk, and that's about getting, unloading some of the positions we've taken. Cy, it's again, thank you for all of your help over the last 6 years. On anniversaries tends to be a time when we thank people for what they do. Kim, for standing with us and for filling in whenever we've asked. We really appreciate your help, as we do the help of all the guest damsels and guest knights that have appeared in the last 6 years. Special thanks again, Mark. You're just the greatest. You're the rock that this whole thing is built upon, and we appreciate it.
I need tomato steaks, so I'm going to Tractor Supply.
Just got to go to Tractor Supply and buy those steaks. Okay.
There you go. Yes, very welcome. My pleasure, Ken. And are we renaming Mark Rockerson?
Rockerson, okay. With that, we're going to call it a night. Thanks, everybody, for coming, and we'll see you next month. We will be on the last Tuesday in August, and in fact, we're going to try to stick fairly close to that last Tuesday for the next couple of months. Thank you all. Good night.
Thanks, Ken.
Good night,
everybody.